if somebody wants to start a business, they've found a niche, however they don't know how to finance their business, then the simple ways to start small. Start as small as you can. Work from home, work from a garage. Just get the basics happening. And soon enough, if it is a good idea, if you have found a good niche, then the business can grow. And then once the business has started, then there's a whole sorts of different options available for financing. Yeah, it's going to be difficult to get a bank loan with just an idea, but yes, there are government grants. If you found your niche to be in an export market, then there's the export market development grants offered by Australia and the federal government. They'll pay a percentage of your expenses to promote your product overseas. There's lots of other grants and things available if it genuinely is a good idea, and there is the possibility of making profit out of it. Starting a business who's looking to figure out how to finance or just to get some general help and assistance, I can recommend using local business chambers. In particular, I've had good experience with the New South Wales Business Chamber. They've got lots of services available that aren't very expensive. They've got experts in a lot of different fields. They've got people who can help you out with different government grants. In particular, they can introduce you to the various Oz industry type people. And that's a great starting point, because they'll come out and they'll do a free analysis of your business, and then they'll give you recommendations and advice if you do qualify, and how they can help you. When you're starting off and you've got a great idea and you believe it's worth quite a lot of money, and you're trying to convince your friends and family that it's this great big idea that's worth a lot of money, but they may be a bit skeptical, I think it doesn't hurt to kind of give yourself a little bit of a reality check. Really go out there and really investigate how and where you feel you're going to make money in the particular industry that you're looking at. An idea is an idea, but until you can show, where you're going to sell it, how much of it you can sell, what kind of profit margins could you make on it, that's really the only way to determine really what is it worth. An idea is not really worth much until it starts making money.
When the idea is your own idea, you're going to give it the highest value possible because you just think it's the best thing since sliced bread. So you have the most passion for your idea than anyone else in the world. And that's where the difference in valuations lie. Because someone from across the ocean who is only looking at the opportunity and the risk. They're looking at the opportunity for them to recoup their money and make an investment, return on their investment, but they're also looking at the risk of how likely is this to even get off the ground? How strong are you as a person that they're going to invest in to execute on those ideas? And they're all unknown factors for them because they don't know you. So from their perspective, they're going to have a much lower valuation of what your business is worth in there compared to your own self.
Certainly in the startup phase, I mean, if you're starting from a low base cash-wise, you've really got to look at where you can get a bit of capital into the business. And at that stage, I think you're really probably looking at, friends, family. There are other options with sort of angel investors and crowdfunding and things like that. But really, the banks and that, if you want to go and get a loan, are probably for further down the track with your business. It depends obviously on how much the money that the business is going to need with regard to startup costs. So if you're going to need a lot of equipment and things like that, you're really going to have to go out with a good business case and a business plan and be able to explain your business to people who may be looking to invest in businesses. There's a thing called the granny test, which is really about being able to explain your business in a simple form to your granny. Because if she can't get the idea of what the business is, other people who are going to invest are probably not going to get the idea either. So you really have to be able to have a simplified way of explaining your business, but also you need to have quite a detailed business plan to show people that you've thought about this and how it's going to work as you go forward.
Generally, it's friends, relatives, and supporters as the kick-off, the first port of call. They're investing in you. You know, you've got a great product, but they're also investing in the management, the guys that are driving it. That's the most obvious one and the first place people go. If it's a great idea, you can actually put the proposal up to high net worth individuals, venture capital funds, and so forth. Again, they want to see that business plan. They want to see that you've de-risked the business opportunity, that you've identified your market, that you've got a clear path to market, that you're not making a 5% profit margin, you know, that all of these core factors are there. In other words, you put together a compelling, well-researched, de-risked transaction, and that actually opens up a much, much wider range of potential investors and funding for you. The more work you do on that, perfecting your story, the greater the market you can take your story to.
In the past, it used to be traditional banks and applying to financial institutions based on a business plan that you would present to them. But nowadays, we have digital innovation loans from governments. You know, we have grants, we have incubators that will actually invest in your business and take a small percentage or sometimes a large percentage, depending on how mature your idea is, and in return for the funding that you need, for a 1, 2, or 3 year plan. And then, of course, there's angel investors, which is a step beyond incubators, where they'll come in and assess your idea, and if it's a truly global idea, which is how angel investors usually work, they will invest on a global scale, and take it to that next level. But generally speaking, you've got to have something very special in terms of uniqueness about your product or service that's not been offered elsewhere, to get to that top level of funding. A lot of incubators around the country in Australia, that anywhere up to $500,000 seems to be the amount that 80% of young people actually seem to ask for. They think that that's all they need to get their idea off the ground and create a business out of it. But the reality is that $500,000 is not really a whole lot of money in terms of setting up your average chicken shop across Australia. If it's a franchise business, it'll cost you at least $500,000 worth of funding just to fit it out with all the particular setup that they require, to make it look like a brand new shopfront. But as opposed to in America, the average incubator fund normally starts at a minimum of $1.5 million. That's the actual sort of funding that they look at as a minimum to give to people to start up their business ideas. In Australia, we seem to have a mindset that's a fraction of that. And so my suggestion is that to be realistic about the funding, if you have a 3-year proposition, take all the costs into account, all the growth that you think you might need to fund that growth, and all the resources you'll need to put into that business, and be realistic about it for when you go for your funding. So if it is in the millions, if it is in the few millions even, be realistic about that, because you won't get a chance to borrow it down the track once you've already run out of money by year 1.
If you know where you're going, then it's easy to work out what it takes to get there. So if you want to have a turnover of $20 million by the end of year 3, you know what your manufacturing capability has to be there. You know if you need distributors, what sort of margins they require. You work that back and you see exactly how much money you require on a 6-monthly base to get to that end result. And that will be your answer. That will tell you exactly how much money you will need.
There are plenty of grants around. I mean, one of the difficulties is actually finding the one that matches your need, but there's like the Small Business Commissioner. There's a lot of agencies. I mean, there's at local, at state, and at federal level, there's different levels of grants available, research and development grants. So it's a matter of probably speaking to one of the small business consultants, the commissioners that are around the place, because they essentially have the in-depth knowledge with regard to what's available through the grants, and it can cut out an awful lot of legwork for you by speaking to someone in that area.
Yeah, look, I reckon it's a great idea. I'd mentioned a little earlier that one of the big risks for a new venture is to try and cash flow fund the growth of your business. So it's a long, hard road. Very simply, what you do is you go to your business plan, look at where your business will be cash flow funded in 5 years' time. And then say, inject $1 million into that business day one and see how you would spend that, where your business is likely to be in that same 5-year period. Now, if you're only marginally better off, then you don't need the injection. If in fact it's allowed you to capture early market share, significant market share, and you're 10 times better off, then that early investor is the guy you should seek. So it's the impact of a significant capital injection up front, which is the determining factor which way you're going to go at the end of the day. And 9 times out of 10, the more money you throw at the beginning, the greater the likelihood of your company being a success.
That really depends on two things, and which direction your product or service is going. If your product or service is on a local level, on a local business level, for instance, within the Sydney market, and I won't say Australian market because then that's bordering on global, but if you're truly only offering a business or product or service for a particular city, it doesn't make sense to get an angel investor involved, and they probably wouldn't even look at you in that regard, because the opportunity for you to grow that business and make it a sizable opportunity within that city does not require the sort of funding required by an angel investor. But if your product or service is on a global level, that's a different proposition. And again, they wouldn't be looking at you unless you had something unique in terms of its disruptive nature for your product or service that addresses a gap in the industry that you're servicing. So I would suggest that if it's a global product or service with a uniqueness about it, you'd be attracting interest before you even approach them. People would hear about your idea and should be knocking on your doors rather than the reverse. But as is often the case, you've got to shop it around. An angel investor is really someone who comes in on the ground floor, like on the basement floor of your business idea, and they generally will commit a certain amount of funding required for a 1 to 3 year business plan, generally speaking up at least 3 years, in return for anywhere from 15% minimum is usually the norm, up to about 30 to 40% of that business equity is owned by that angel investor if it succeeds. But we're talking about, minimum $500,000 is usually angel investment funds, and can go up to several $1 million. And that's where the percentages usually lie somewhere in between there, and based on the idea itself, how lucrative or likely it is to get off the ground based on its uniqueness.
Obviously, a profitable idea. Investors are very savvy in terms of their cash flow. So they have to see how passionate you are, how knowledgeable you are, and how serious you are about the business. And they'll ask you all sorts of questions about, how, what do you know about financially? What do you know about your idea? And they obviously are not going to invest in somewhere where they don't see the future.
It's absolutely the quality of the management driving it. So if you've got a clear vision, you're able to convey that vision succinctly, with complete commitment and confidence you're going to get there. You can show that you've addressed the risks. This guy's not putting his money in to go to the races. You actually value their dollars, and you're making sure you've minimised the likelihood of them losing it. At the same time, maximise the likelihood of them of making significant dollars. That's the key. So the guy that's behind the deal, and then obviously the quality of the deal itself, how much IP protection you've got. But yeah, you've invested in people and ideas. The business plan, as I keep saying, is what it's all about, because that articulates the vision and how you're going to get there. Okay, but you need to tick all of the fundamental boxes. Like I see people that have got a proprietary limited business with 4 shares on issue, and they're looking for $400,000, and that person gets 1 share in the company for $400,000. It just looks amateurish. They haven't worked out where they're coming. So they're building the company as it goes, rather than setting it up for success in 3 years' time. It says they're not looking ahead. So all that base work you put together, getting your shares on issue right, your intellectual property probably covered, your outsourced manufacturers contracted so they can't reverse engineer your technology. You just got to run through a series of these boxes to make sure this looks like it's going to be a winner day one. You don't just walk out with an idea and say, hey, here I am.
The preparations are really just the basics of having financials laid down on a spreadsheet in at least, I would suggest, a 3-year plan, because I don't think any financial institution nowadays would want to, they'd see you as a risk factor if you only had 1 year's worth of financials, because they know that the first year is going to be the toughest. But over a 3-year spread, they know that that's a reasonable indication and timeline of realistic, results that you might expect to obtain. So I would suggest financials, a strong business plan showing all the SWOT analysis and showing the financials that are anticipated, the projected income. Beyond simply having financials to present to an incubator, an angel investor, or a bank, to give you that financing, you can otherwise take out, finance against your own assets, be it an apartment or a house, and or family or friends. But equally so, you would need to convince them that what you have is a strong proposition, and so that they know that they'll ultimately going to get their money back. So it still comes back to a business plan and showing financials within that business plan.
Rejection is a daily part of life. Don't repeat the same mistakes which you did in the past. Could be a hidden opportunity in a rejection.
Any criticism you receive is an opportunity to learn something and take it away and improve upon what your original pitch or your pitch or your business proposition actually portrayed in the first place. Improve upon it, find out what was actually the rejection, the advice that was given, address those concerns, and edit your business plan and your pitch and your proposal to actually cover those points in detail, so that the next person that you pitch it to shouldn't have to bring up those objections at all. And in fact, you'll have a much improved pitch in the process.